In July, the U.S. Treasury yield curve, measured by 2s versus 10s, hit a 40-year low of negative 108 basis points. An inversion is generally viewed as a predictor of a recession for several reasons, the most obvious being that it's suggestive of interest rates being too high in the short term, which could cause economic stress and force yields in the future to move lower. Normally, when the yield curve begins to right itself, or steepen, it's because the Fed is pushed to lower rates rapidly on the short end because of a fast-developing recession, and long-end rates go down in sympathy, but not as fast as short-end. The yield curve movement over the last 4 months, though, which has brought the spread to negative 17 basis points, has been quite unusual. Yes, it's steepened rapidly, but it's done so based solely on a dramatic rise in long-end yields and almost no movement at all in 2-year. This is called a bear steepener because bond prices are moving lower. This anomaly has caused some analysts to make the prediction that no recession is coming and that rates will be able to stay higher for longer, with the backdrop of a strong economy. Others are not convinced and have argued that increasing amounts of bonds being sold by the government to fund spending projects is pushing yields higher and may increase the possibility of a domestic debt crisis where the Fed loses their grip on long-end rates and they become unacceptably restrictive.